Good afternoon to our audience members in the Eastern and Central time zones, and good morning to everyone else across the country. Marty Borosko from Becker, and I will be moderating today's webinar. A couple quick ground rules for the webinar. We will be recording the webinar, and a link to the recording will be sent to all audience members later this week. We have a lot of ground to cover today, the rules and the evolution of the PPP program, some of these tax issues we'll be discussing, and the EIDL loans have been developing rapidly, and there's a lot to cover with respect to those. So we anticipate that we may go a few minutes longer than the hour we slotted in our email invite. We hope to have the opportunity to answer audience questions. There's a mechanism on your GoToWebinar screen for you to type in your questions and send them to us. Please do so. In the event we are unable to get to a question, we will be reaching out to you individually after the webinar to answer the question. For those of you who don't know me, I am Marty Borosko. I am the chair of Becker Staffing Group. Becker is a boutique law firm with offices on the East and West Coast. We focus our practice in several discrete industries. Our largest industry practice group is our staffing industry practice group. We represent over 100 staffing brands across the country. We offer advice to staffing firms on both their strategic and legal needs. With respect to their strategic needs, we offer advice on things such as corporate structuring, corporate governance, corporate finance, key employee compensation, and mergers and acquisitions. On the operational side, we offer advice to help staffing firms run efficiently and compliantly. That advice includes employment law compliance advice, guidance on best practices on onboarding and offboarding contingent workers, and client contract review. I spend most of my time on strategic issues such as corporate governance, key employee compensation, and mergers and acquisitions. My team and I have advised staffing industry clients on over 30 mergers and acquisitions in the last 3 years. Very excited. We have a very distinguished panel with us today, members from Becker and UHY advisors. From Becker, joining us is Anthony Vizzoni, one of my partners. Anthony is a member of Becker's board and chair of our corporate business services group. He focuses his practice in a couple of areas, including, as is important for today, in the area of finance. He has been assisting our staffing firm clients over the past 10 days on PPP loan related questions. Welcome, Anthony.
Hi, Marty. Thanks for having me.
Anthony will be joined by three principals from UHY's Staffing Advisory Group, which is one of the largest advisory groups in the country to the staffing industry. The members of UHY's team have over 35 years experience representing staffing firms, and they represent over 125 staffing firms across the country. The team provides a full complement of business and accounting services, including business advisory services, transaction advisory services, tax planning and compliance services, and audit and assurance services. We are very lucky to have Grady joining us, the chair of that practice group. I've had the pleasure of working with Jerry on clients of ours. Jerry is a key strategic advisor to his staffing firm clients. He assists them in developing their corporate growth strategies. He assists them in improving operational efficiencies, increasing profits, and identifying tax savings. Welcome, Jerry, and thank you for joining us.
Thanks, Marty. Appreciate it.
Also from UHY, a principal of UHY is Loni Winkler. She is an active member of their tax department. She manages a group of tax professionals and has expertise and experience in providing advice to corporate and flow-through entities on taxation at the federal and state level. She regularly works with UHY's staffing industry clients on complex tax structuring and planning matters, and she has been working around the clock with the firm's clients to help them understand the various tax deferral programs, tax law changes, and tax strategies that exist for them to help them cope with this crisis. Welcome, Loni.
Thank you very much, Marty.
And last, we have Ali Baydou. He is also a principal at UHY. He's a lead member of the Enterprise Business Services team. Ali focuses his practice on advising middle market companies on consulting, tax, and attest matters. He has taken a lead role in assisting UHY's clients in understanding the opportunities that exist for them under the PPP and EIDL programs. As you will see today, he has a good deal of insight to share regarding the fine details of these programs. Welcome, Ali.
Good to be here, Marty. Thank you.
So the focus of today's program is going to be on three different areas. The first and the place where we'll probably spend the primary amount of our time is on the CARES Act SBA PPP loan program. We'll also be addressing various tax programs and tax strategies that exist for staffing firms to help them cope with the COVID-19 crisis. And finally, we'll be discussing the EIDL program, the loans and grants available under that program. At its foundation, the PPP program has tremendous potential to provide relief, at least some relief for small businesses from the impact of this crisis. As we all know, the U.S. government set aside in this first tranche $349 billion for these forgivable loans. There is, of course, discussion that they may be setting aside up to another $200 million for these loans. That obviously has not been approved yet, but it is being discussed. The rules governing this program have been evolving rapidly and changing as they evolve. Our panelists have been tracking these changes and helping our clients understand them. And I guess the place to start, Ali, is with eligibility. Maybe you could give our audience a quick overview of how staffing firms can determine if they're eligible for a PPP loan.
Sure. So in general, the PPP program was launched essentially to allow small business concerns or companies under 500 to qualify for the funds. Now, the SBA has some clear definitions of what they define to be a small business concern. And as it applies to staffing companies based on their NAICS code, it's essentially a revenue standard that's out there. That's the standard that's set. And it's pretty much staffing companies under 30 million should qualify. Now, there's other ways to qualify for the program if the staffing companies exceed the revenue size. Pretty much if they have less than 500 employees, they also automatically qualify for the program. And the SBA recently, over the last couple of days, clarified that another test is also available for companies that don't meet the first two that we discussed, that can still be used to qualify an entity, which is a tangible net worth test of 15 million and an income test, an average income test over the past couple of years, 2 years exactly, of less than 5 million after tax. So there's technically three ways where a company could qualify for a PPP loan should it meet any of those conditions.
Thanks, Ali. Anthony, let's drill down a little bit on the second way that folks can qualify, and that is by having 500 or fewer employees. Obviously, in the staffing industry, we have two different sets of employees. We have internal staff and we have contingent workers. A couple of related questions in terms of counting how many employees you have. Anthony, maybe you can explain what the definition of employee is under the PPP program. You can also advise whether contingent workers count as part of the 500 employees, and also maybe indicate at what point in time are you measuring how many employees that you have to determine your eligibility.
Sure, Marty. So employees are defined as individuals employed on a full-time, part-time, or other basis. And the contingent workers do count as part of the 500 count. The point of time with respect to measurement of the employee count is based on the time of filing of the application. So when you complete the application, there's actually a question where they do ask the number of employees, and at that point in time, that's where the account triggers.
Nancy, as a follow-up, with respect to the contingent workers at that point in time, does it matter how many hours that contingent worker has worked or not worked, or are they counted if they've worked even 1 hour, at that point in time?
Yeah, there doesn't seem to be any. They don't seem to take into account the number of hours. As long as that contingent worker was employed, worked, then that's going to be a count.
Thanks, Anthony. Now, Ali, we've had circumstances with our clients where they have quite complex corporate structures, right? They're operating through multiple entities. They might be parent and subsidiaries. There might be brother sister companies or other affiliates. How does that work? How do you count employees when you have a more complex corporate structure?
Marty, for SBA purposes, the affiliation rules are pretty complex, but they essentially look at everything from a count perspective on a global basis, and they count affiliates, including foreign affiliates, in the count of employees. So if you have the brother-sister relationships or multiple entities, what the SBA is going to look for primarily is a approach for control. And from an ownership perspective, it seems like everything that the SBA looks at is a 50% or more rule on determining whether entities are under common control. But their definition of control is a lot broader than just the ownership perspective. They look at common management. They would look at common officers between companies. So even if you have disparity in ownership between two companies, they could still be considered affiliates under these rules. And essentially, you would have to look at the count of the group in general. And what's interesting is the application, as it evolved through this program, moved away from telling people to disclose affiliates to now kind of telling people to disclose any common ownership, or owners essentially of an applicant to disclose any common ownership of either entities that they have, which seems that they want to know everything, and then they can determine whether there's an affiliation rule or not that would be applicable.
Thanks, Ali. Also, Anthony, what we see with some staffing firm clients, as you know, is the practice that they may store some of their internal staff or even their contingent workers and put them in with PEOs or employers of record instead of keeping them on their own payroll. Can you explain whether or not those employees can be counted in the 500 or fewer count, and how it works with respect to staffing firms that have placed either internal staff or contingent workers with PEOs or employers of record?
Sure. So if the applicant wishes to include those workers as part of the applicant's payroll cost, then they could certainly include them. So that's acceptable. Actually, the payroll documentation provided by the PEO would indicate the amount of wages and the payroll cost, reported to the IRS by the payroll provider. That is considerable. That's considered acceptable PPP loan documentation for purposes of the application, in the lender's review. The caveat is those employees, if they're considered employees of the payroll provider or the PEO, then if the applicant is including those employees, then the PEO cannot apply or cannot use those counts as part of a PEO's PPP application. So you can't double dip in that respect.
Thanks, Anthony. I think we've
Marty,
given a pretty good explanation. Yeah, jump in, please.
Sorry, I just want to backtrack on the affiliation rules for a second, just to clarify a point that the affiliation rules apply not just to the employee count, but they will apply to any of the three eligibility kind of tests, whether it was the revenue of 30 million or whether it was the alternative test of the tangible net worth and net income that's out there. So everything that you're trying to, when you're trying to determine whether an entity qualifies or not, is taken on an affiliate basis.
Thank you for clarifying that. That's very important. I actually want to shift gears because that's a good segue, Ali. I want to shift gears. We've talked on, I think you explained in detail a lot how you go about counting determining whether you're eligible because you have 500 or less employees. As you indicated at the outset, there's two other tests that are available. So if you have more than 500 employees, there's two other opportunities for you to be eligible. One is to qualify, I guess, as a small business under the SBA regulations, and you indicated that was a $30 million threshold. Could you give a little bit more detail about how staffing firms can determine whether they fit under that threshold or not?
Yes, so essentially the small business concern is a definitional term within the SBA guidelines for general loans in the SBA, and they maintained it for this particular PPP program. And essentially, as long as you have your average gross receipts over the past year are less than $30 million, you can go on the SBA website and take your SIC code, your staffing company SIC code. You can plug it in and give them your average gross receipts, and they can tell you, hey, yep, you do qualify. So if on an affiliate basis you're less than that 30 million, then even though you have more than 500 employees, you would still be eligible for this loan.
So that's the second way, and now you've indicated that the guidelines have come down with a third way that staffing firms could be eligible. That seems to have two different tests. One seems to be a value test, and one an income test. Could you go into a little bit of detail about that third way that staffing firms can qualify?
Yep. So there's an alternative size standard test that's also out there. So it's tangible net worth, and there's no clear definition in the SBA guidance for that, but our reading of it is essentially it's your equity minus pretty much goodwill or any other intangibles that are out there, and that essentially gives you, if that number is less than 15 million, then you meet the first set, and then the second piece that you have to verify that you meet is an income test where net income, the average of the past 2 years net income after taxes is less than 5 million. So you have to meet both the 15 million and the average net income being less than 5 million for 2 years. If you meet those two, you could be over 30 million in revenue, over 500 employees, but still be eligible essentially for a PPP. And it's important to note that the concept of net income after taxes is essentially even applicable to companies that are flow-through entities or are being taxed as S corporations or partnerships, because under other approaches, the SBA has taken the stance that you almost do kind of a hypothetical calculation of what your tax would have been using marginal rates for state and federal to get to that net income number. So if you're an S corp and you'd say, hey, I'm over 5 million because I don't have any taxes, you can still model in what taxes would have been and essentially try to drop below the 5 million and still qualify.
Marty, if I can add a little more color on that, I think it's important from the staffing firm standpoint too, that Ali pointed out. Many staffing firms have really 2-3 assets: AR, cash, and the intangible asset of goodwill. They have very, very little furniture, fixtures, equipment, buildings. And so by adding back or subtracting out that goodwill, that's going to allow many staffing firms who probably thought there was no way they would fall into it, will be able to fall into this PPP program. And then I think we also should focus on the fact that they did not define whether it's your tax return net income or it is your financial statement income. And with that, as you know, many staffing firms are usually based on a cash basis tax return. And so that would also benefit some staffing firms that if they are filing under cash basis, we have seen a lot of those being under 5 million. And then as you jump into the flow through entities, for the most part, our staffing firms do pull most of that income out as a C corp or as a S corporation or as an LLC. A lot of that income is pulled out and paid out to the owners, and therefore leaving a little bit into the business, thus keeping their net worth at a lower value. So I think that's important also to note.
Those are incredibly important points because I think as this first came out, there was a lot of feeling by staffing firms, given that they have such large contingent workers, right? That 500 or less employees was their only way to become eligible for this, and therefore they thought they wouldn't be eligible. But you can really see that this has opened up quite significantly, and that if you're working with the right folks, folks like on the advisory end, there's a lot of room to fit staffing firms now within the eligibility rules. I want to shift gears, Jerry, and stick with you a little bit. You had given some really good news for us all to hear before we started the broadcast, and that is that UHY actually has a client that's received some money. So why don't you share that good news with everyone so that they realize that this isn't just theoretical and there is actually money that will flow out from this program.
Yeah, excuse me. Yes, this morning we actually had gotten word that two of our clients actually were funded today, which was outstanding. And as Ali had also mentioned to us earlier, one of those clients actually applied just a few days ago. So, we cannot provide any rhyme or reason of how it's happening, but they did get funded. And so now there are dollars out there. I believe as these banks are all trying to grasp exactly what we've all been doing the last 10 days, I do believe that funding will become very, very quick in the next 5 to 10 days. We read a report this morning that let us know that many companies out in Utah have also been funded by over $39 million in the last 2 days. So I believe it's just a matter of the banks, unfortunately, getting their arms wrapped around the lending process and getting all the documentation. And then I think that you're going to start seeing a lot more funding coming down the pipe for people.
And just to follow up on that, Joy, because I think we've done a good job of discussing eligibility rules, but staying practical for a moment. I know you're dealing with this every moment of the day, basically, probably. What advice are you giving to your staffing firm clients about getting their applications in, how to go about that process, where to go about that process? Can you share some of that with us, please?
Yep, yes, I can. We started with all our clients as soon as the CARES Act passed last Monday. We actually started calling all our clients and started getting the data that we felt they were going to need in place. The first place they really need to go to is to first start putting together and grabbing their payroll. We've been recommending that they do get their 2019 payroll because that's the easiest payroll to grab. They have it already. They have all that available. And they would go through and accumulate all their payroll data, their UIA tax data, their health insurance data, and then any of their 401k and pension dollars. We actually created a spreadsheet for all our clients to help drive that data as a process to get it together. Then as the banks were coming online, we were working hand in hand with them because the only way they can apply is they have to go through a bank. And for the most part, they were bank portals that were set up. That bank portal was set up so that they could easily drive the numbers. The application was out there, and we start using a draft application for our clients so that they could start gaining the numbers and data that was needed. And Ali, correct me if I'm wrong, but there's only 3 numbers that are needed on the application now. Your gross payroll cost, it multiplies that times 2.5 so you know your loan value, and then it asks for how many employees did you have for the measurement period. Those were the only 3 numbers they needed. And then if you had all your backup data behind, you would upload that very quickly, get assigned a number at the bank, and then now you're working hand in hand with your loan officer. So the first place I'd recommend to anybody on the phone is first talk to your advisor, talk to your loan officer next, and then make sure you've gotten into the portal so that you have your loan in place.
Thanks, Jerry. Anthony, I know that you've been working the phones feverishly since this program came out, calling all of the big lending banks in the staffing industry and even other industries. And what are you learning from them? What practical tips do you have for staffing firm owners on who they should apply to? Maybe you can share some of that information.
Sure. So the majority of the lenders are opening up the program to their existing clients. Of course, those clients that have good relationships with the lender. So I've heard a lot of thank you for referrals, but we're not taking on any new clients right now. So we're sticking with our existing clients because most of the lenders are viewing this as an accommodation to their clients. I don't think it's a big moneymaker for the bank, so they're viewing it as facilitating their client relationships. So the lenders have allocated amounts in terms of the program. I spoke to one lender yesterday, and they said that they had processed about 500 applications more than what they had allocated, and over 65% of the amount that they had set aside for the funding. Right, so they're making good on that. They're still going to cover, but there's certainly a huge demand for this. So it's critical to have a good working relationship with your bank so that they could quickly get your application in for review and approval. Like Jerry mentioned, proper documentation is critical in terms of getting through underwriting. What's worth noting is that lenders are only required to perform a good faith review of the application in a reasonable period of time. So to the extent you have a good relationship with your existing lender, the underwriting process will be that much less painful because they have a relationship with the borrower, with the applicant, so they're going to move it along and they'll be very comfortable in terms of the documentation and the certifications that the borrower is providing. So the better the relationship that you have with your lender, the more confidence the lender will have that the borrower's application and the supporting documents are pretty much in order and ready to be processed.
Thanks, Anthony. So I think that the two important takeaways for audience members on this point is that there are three different ways you can become eligible for the PPP program. It's broader than everyone initially thought for staffing firms. And then the second thing is speed, that if you haven't applied already, it's really important to get that process started immediately because the banks are inundated with these applications, and in some instances have already filled the number of applications that they're going to process and have closed their windows to new applications. And I kind of want to move on to the next topic.
Hey, Marty, let me add one point to that, if it's okay. So we're starting to see some of these lenders that have shut down the program already because they're oversubscribed. What they're doing is they establish relationships with third-party groups. So to the extent that there's other approved lenders, I think Cabbage is one of them, Raintree Funding. So what they're doing is you're going into the bank's portal, the bank is taking the application, and then they're kicking you out to this third-party group who will actually provide the funding and who will take the application from there. But they're doing that, of course, because they want to maintain the relationships and do whatever they can to their to keep their existing clients happy to the extent that they're oversubscribed. So.
Hey, Ali, I just want to go back to the affiliation rules for 1 second because we actually had this issue before, and I believe one of the audience members has this issue as well. On the affiliation rules, if you are an owner of a company that is not in the staffing industry, obviously you can have subsidiaries and brother sister staffing industry clients. Does that unrelated, and I know this is complex and you probably need to get the details of this, but could you just walk somebody through where you own a company in another industry, then obviously you own a staffing firm, and how the affiliation rules may work between those two companies, even though they're in different industries?
Yes. So in essence, when you have multiple industries, the SBA is going to look for what they deem to be the primary industry. And they'll look at kind of facts and circumstances between the companies to try to identify what that is. One of them would be like your gross receipts. So if you have two companies, but one of them is clearly a lot more substantial than the other, or the number of employees that each one of them might have. And usually the primary industry would dictate which standard size would apply, in terms of the standard size table that the SBA has put out there. And so if you have a staffing company in another unrelated business and they're under common controls, they're going to be deemed to be affiliates. If that unrelated business is substantially larger than your staffing company, it will dominate whether or not your staffing company can qualify or not. But that's where I believe that third test of the 15 million and 5 million net income and tangible net worth is critical, because that one is not tied to any type of industry. So even if now you take your affiliates and you combine them together, if you're still under those thresholds, now you can have them both qualify for a PPP loan.
Thank you. And audience members, just remember that these affiliate questions are very fact specific. So if you have concerns about the affiliate questions, you should reach out to your advisors, reach out to Jerry, Ali, Loni, folks like that to give you, to walk you through how that would actually work. I want to shift gears here a little bit and talk about calculation of the amount that you're eligible to borrow. So Anthony, once you realize you're qualified and you're eligible, can you talk about what is the formula that's utilized in determining the amount that you can borrow?
Sure. So I think Jerry touched upon this, right? So it's generally the average total monthly payroll of the business, the payroll cost during the 1 year period prior to the date on which the loan closes, times 2.5. So you look at your average monthly payroll cost, and then you multiply that by 2.5 per month. The actual application, the SBA Form 2483, directs you. It makes a statement that most applicants are using the monthly average payroll cost for 2019 as opposed to the prior 12-month period. So what I'm seeing is most banks are basing it on 2019 payroll. The payroll companies are issuing their reports that are used with the application submission for 2019 payroll, and that's the direction that most companies are going with.
Ali, it seems that the key to determining your loan amount is this term payroll costs. How is that defined under the PPP loan program?
So under the loan program, payroll costs essentially include pretty much gross wages or any commissions, tips, vacation, even severance. All that grossed up is one bucket. Then you add to it and let me clarify, that is all capped at $100,000 per employee. So there was a lot of confusion early on with whether the $100,000 was going to apply to a bigger pool or just compensation. And I think the latest FAQ that Treasury released clarified that the cap for $100,000 per employee is on the cash compensation that they receive. So it's their salaries, wages, and commissions type income. In addition to that, you get to count the health insurance premiums that you pay. And I would say that that's probably net of any reimbursements, obviously, that you get from the employees. You get to count any retirement benefits that you pay. So that would be 401k matches. If you have a defined pension plan or defined benefit plan, any type of contribution to that would count. And then they count the state and local taxes assessed on compensation. Our reading of that is it's pretty much essentially your state type of unemployment taxes that would count. So that together gives you your pool of payroll costs. Now they do exclude a couple of items that cannot go into that pool. One of them is any wages or salaries compensation paid to a person whose principal residence is outside the United States. And then the second is pretty much your payroll taxes. So that would be the FICA, Social Security, Medicare type taxes that are the employer share out there. Also, there was confusion, Marty, about that, whether the employee share had to come out of the payroll. And I think there was some definitions that came out that clearly now say that it's gross payroll, not net payroll, is what you'll use to determine the payroll cost that you're going to take, the average times 2.5.
Hey, Ali, if I could just add one point to that. Yeah. I've seen some clients who have prepared their internal spreadsheets, and what they're doing is they'll take an employee whose in at 150, and they'll just put the number at $100,000, not taking into account any other costs associated with that employee. And what the calculators that I've seen coming out from the lenders, they look at categories. So they'll look at the total healthcare costs, they'll look at the total retirement benefits, then they'll take the employees, and if you're at 150, they'll take you at $100,000, right? They'll deduct out the 50. But the point is that they do look at all the other costs beyond wages of $100,000 and give you credit, even though specific to that employee, the payroll cost associated with that employee will be beyond 100. It's only 100 out to the pure wages.
Yeah, and what's interesting on that point, Anthony, is essentially because the guidance on the $100,000 came out actually very late compared to when the application process had opened, because they didn't clarify it till they released some FAQs. I believe it was April 7th. So the process had been open for 4 or 5 days. You had seen a lot of banks, each bank interpreted it a certain way. So you were really, as an applicant, you were at the mercy of how your bank was setting up their calculator. And that's how they were viewing it. So some banks were capping it at a full $100,000 and some banks were not. So it was very interesting to see that essentially on something that should be uniform, you had people, depending on what bank they were going to, were getting either more or less.
Exactly. Yep.
We just had a very good question from the audience, and this audience member said that some of his clients are asking for his payroll information for the contingent workers he's placed with them because they evidently want to use that in calculating their borrowing base. What do you guys think of that?
Ali or me? I mean, this is Jerry. Sorry. What we've been following is the only ones you can do that with is the PEO. Yep. That you cannot add because they are not employees of record on your payroll. And so therefore it is not applicable to be having temps put on an application for where that temp is working at.
Yeah, and it's in the law, it's defined that all those payroll costs are specifically tagged to employees. And so you have now a disparity between what counts as an employee for the headcount portion and what counts as an employee for this calculation.
Thanks for clarifying that, Jerry and Alan. Anthony, I know we've dealt with this question a number of times from our clients, and many staffing firms, depending on the segment that they're in, may have contingent workers who are here on some type of work visas. And the question we've dealt with a number of times is, can we count those employees in calculating the loan amount that they qualify for? Can you explain the rules on that for us?
Sure. So excluded from the term payroll cost is compensation for any employee whose principal place of residence is outside of the U.S. So to the extent that the employee does not have a principal place of residence in the U.S., then you cannot take advantage of that cost in your payroll cost. So it has to be somebody who has a residence in the U.S. And I think they look at the Internal Revenue Code standards with respect to residency.
And picking up on that, Ali, that they do look at those IRS standards. Can you explain what the IRS residency standards are, or at least give an overview on that?
Yeah, I mean, the IRS looks at residency in a couple of ways. One is like a green card test type of approach. So if you're a resident alien, you're qualified as a resident for tax purposes. However, you can still meet the residency rules for the IRS and be taxed as a U.S. resident, even though you're not a citizen or a resident alien. And essentially, those are kind of a number of day test that's out there that is dictating that you spend about 31 days in the current year, as well as 183 days over the last 3 years in the U.S. And they average those 183 days based on a kind of a weight scale that's applicable to each of the years. And so with that, that's how the IRS looks at that. But those residency rules from a tax perspective are complicated because treaties come into play with countries where now, the general residency rules would not apply, or there are certain exempt individuals that would be also, depending on what visa status they have, could be excluded from the application of these rules. So it's a very fluid type of analysis as it pertains to those type of rules.
Thanks, Ali. And I guess this is a little bit similar. A lot of staffing firms will contract with independent contractors to help fill out their contingent workforce. And the question we've been receiving is, can you count the payments that you make to independent contractors as part of your payroll costs and include that in your borrowing base?
Well, that one was also finally clarified with the rules that they released, because that caused a lot of confusion. And essentially, independent contractors are not counted in payroll cost for an applicant. Their reasoning is independent contractors and sole proprietors can also apply for the loan themselves, which we're waiting guidance on. And therefore, they didn't want people double dipping by having a person who paid the cost get 2.5 times that, as well as the recipient. So they limited it to the recipient. So the answer is no.
Thank you. Yes, I know there was a lot of confusion about that, given the initial language in the law when it was passed by Congress. So I guess the next question with respect to this, Ali, and maybe I should direct this to you too. Do the affiliation rules apply in calculating your borrowing base?
So right now we're reading it as essentially when you determine that you have eligibility out there in terms of if you have multiple entities, as long as you're not, even if you have affiliation, as long as all the entities are eligible, each of them can go and apply to their loan as a standalone applicant, and their 2.5 times would be calculated on a standalone basis.
Got it. We've had some pretty interesting permutations of this. We have a client that's in the middle of kind of completing an acquisition. It closed, but the transfer of H-1B employees was going to take place post-closing. So they have a question now of, can they, and it's with a non-affiliate, so they can't just count it in because it's an affiliate. So they have a question of, okay, what do they do with those H-1B employees? Do they keep them at the other company, the company, the seller, or do they bring them over? Can they count in that money in their borrowing base? Maybe Ali or Jerry, you could share some complex issues that you have been dealing with in terms of both eligibility and borrowing base calculations.
So from my perspective, I have a few clients that have H-1B, but it hasn't been in where there's a moving type of acquisition. But what was interesting is I had one today that asked questions where they have a couple of directors that are coming from Germany to the U.S. and they are here. One of them was in the U.S. from 2018 forward and essentially is planning on and being relocated to Germany at the end of 2020, and another one just arrived currently, essentially almost to the U.S. and is going to be here on a long-term assignment. And then, how do you determine those? Is the principal place of residence in the U.S. or not? And again, those items are very facts and circumstances, and you're taking a position that you have to also talk to your lender and get them comfortable with what you're doing, because ultimately they're going to be the ones who are processing that loan amount, and then they are going to be submitting it to the SBA and having to essentially stand behind that type of calculation a little bit, even though it's mainly on the borrower to make all the certifications. So it's depending on also, how we see it and as well as how the bank is seeing it from those type of perspectives. But other clients who pretty much have people and don't have moving targets, even though somebody is on an H-1B visa, they've been, as long as they're living in the U.S. and they have their permanent resident here so far, they've been taking them in the calculations.
Yeah, and I think the one that I've been having the most difficulty with, Martin, is a foreign-owned subsidiary in the United States. As when you look at the affiliation rule, do I include or don't I include all those employees that are working for the parent company over, in this case, over in Israel? So trying to get that clarification and get that clarity locked down and have a full understanding has been real difficult for those affiliation rules. That is where the most of my issues have come, because there are quite a few staffing subsidiaries over here of foreign-owned corporations who would fit the tangible net worth rule and the net income rule. So then we have to go out and grab the corporate balance sheets and income statements from the parent companies to see if we also maybe just meet it under that category.
That's a very interesting question. Jerry, just staying with you for a moment, what are the common mistakes you're seeing your staffing firm clients make in calculating their loan amount?
I've seen really two major ones. One that Ali has spoken about, and that was the $100,000. Many of them are adding all the cost up and then limiting it to $100,000. And so, because that's, as Ali said, that is how their bank application was driven. And so we've had them go back and change all that and recalculate their payroll so that we could increase the payroll dollar lending amounts. The other area that we've seen, and what has really been confusing for them, is the affiliation rules. They might have 2 or 3 staffing firms that were all under 500 employees at that time, and they all felt that because they were separate businesses and they thought that they were separate industry specific, that they were able to apply on an individual basis without taking into consideration any of the affiliation rule. And so I think those are the 2 areas that we have seen the most corrections that we've had to make on applications as we review them with our clients.
Yeah, and another one was just to add to that, another one was the concept of net payroll, because there were some payroll providers who have been developing reports, and as the clients would run those reports, they were being done on a net basis, and some people were taking those and trying to fill out applications. And kind of when we took a look at it and said, no, that's not really our understanding, we're moving towards a gross basis approach. There was quite a couple that were using some canned reports that had either inclusions that shouldn't have been there or exclusions that shouldn't have been there.
Yeah, there's
on our end. Go ahead, Jerry. Sorry.
I was going to say there's a very large payroll provider that they ran their report and it was all on net cost, and people were not going to get the update till sometime end of this week. They would have their update. That that's a major issue for staffing firms who qualified. And now all of a sudden you're at net cost compared to gross cost. You can see how much dollars are being left on the table there.
And I think what we've seen is similar to what you've been saying, is this has evolved so quickly over time that there was not great clarity the first day or two over whether the affiliation rules applied. And so what you have is applications that went in under one set of assumptions, and now the assumptions that they were put in under turned out not to be correct. And I'm really curious to see what happens to those applications in the process. Let's shift gears, Anthony. Let's just talk about what are the terms. I mean, you apply, you get your borrowing base, you get a loan. What are the terms of these loans?
Sure. So it's going to be a 2-year maturity date, subject to forgiveness that we'll talk about later on. But there's a 2-year maturity date, and the interest rate is set at 1% on the loan. There's a 6-month deferment period as to any payments, but interest will accrue during that 6-month period. So you do not have to make any payments against the loan until a period of 6 months from your loan origination date.
And what about, I know folks keep asking, do these loans need to be guaranteed? Are they recourse? Anthony, can you advise our audience members about those issues
Sure.
as well?
Yeah, absolutely. So no collateral is required. It's a non-recourse situation. So no personal guarantees required of any principals. There is one exception. If the funds are knowingly used for an unauthorized purpose, then in that case, the SBA could come back and get the funds repaid from the borrower, and to the extent that the funds were used to personally benefit a shareholder or member, one of the principals of the borrower, then it converts to a recourse situation. They could go after that principal.
And is unauthorized purposes defined under the PPP program? And can you give us an overview of what that definition is, Anthony?
Sure. So they don't have a per se definition of unauthorized use, but they do define the allowable uses of the covered loans. And the allowable uses are the payroll cost. It could be used for payroll cost, payments on mortgage obligations before February 15th, 2020, rent payments on leases that were dated before February 15th, 2020, and utility payments under service contracts that were dated before February 15th, 2020. So it seems that those 4 categories will be the only permitted uses of the funds.
I would add just one category to that on the allowed uses. Because there's the forgiveness piece of the equation as well as the allowed uses are allowing the uses of the funds to go to interest payments on debt obligations outside of just the interest payments on the mortgage. You can use the funds for interest payments on other debt obligations that were in place as of February 15th, 2020. However, that interest payment does not count towards forgiveness.
Thanks for clarifying that.
I mean, and also one other point, Marty, there's no fees to the applicant, right? So the fees are paid directly to the lender. There's a sliding scale in terms of fees that get paid to the lender from the SBA. And then they also permit third-party broker fees to the extent that there's a middle person involved. But the applicant should not incur any fees from the lender or from anybody else on the processing of the application.
Now, Ali, as I understand it, you have to use a certain percentage of the loan proceeds towards payroll costs and other items. Can you explain that to the audience members a little bit more?
Yes, that was a little monkey wrench that they threw at the last minute with the rules that came out. Essentially, it wasn't part of the original act, and essentially now what they want the borrower to kind of certify is on the front end of things that they're going to use 75% of the loan proceeds that they're getting for payroll costs, and then the remaining 25% could fit into the other allowed uses buckets like the rent, the interest on mortgage obligations, as well as utilities. So they're trying to maintain a 75-25 ratio, and their rationale behind that is, well, we're giving you 2.5 times your monthly average payroll, so that should give you 2 months worth of payroll, and then that half turn is what you get to use for essentially other purposes out there.
Ali, that 75% though, that's also subject to the $100,000 cap per employee, correct?
That is correct. The definition of payroll costs from everything that we've seen are consistent between what you can borrow on as well as what you can use it when you get the money. So whether it's in the forgiveness and all that, it's all consistent on what you're using is payroll cost.
And Jerry, so obviously you've got to keep track of where the loan proceeds are going. from a practical standpoint, what advice are you giving your clients so that they can demonstrate down the road that they use the loan proceeds to meet this 75% criteria?
What we've done is we've advised our clients to set up a separate bank account that the funds will be going into so that they now have it segregated. Excuse me. Then we've created a spreadsheet. So on a weekly basis, as they are paying their payroll, they are marking down. Unfortunately, we are doing it employee by employee, so it can be quite cumbersome, but you're marking down each employee by employee with the gross wages they made, and then adjusting that to the 100,000 if we end up going over 100 for that person. Then adding in any unemployment insurance that was paid, mainly your unemployment taxes, and then on a monthly basis, as you're paying the health insurance costs for them, we're adding that, and then we are putting a line in that shows any reimbursements that the employee is paying back. Then you have another sheet that is showing what utilities have been paid for the month, what your interest payments have been paid for the month, and then any of the other qualifying expenses, so that you will have, by the time currently the 8-week period comes up, you will have two spreadsheets. One that has all the payroll information they're going to need for the loan forgiveness portion, and two, the actual percent calculation on how much went to payroll and how much went to the other expenses, so that within that 50-day period, you're going to be able to say, I did everything you asked me to do, and I've covered all my costs accordingly, and let's get the loan forgiveness done.
Let's migrate to loan forgiveness, because that's obviously a very important aspect of this program. Anthony, maybe you could give a general overview of what are the parameters for a staffing firm to obtain loan forgiveness.
Sure. So after the 8-week period, provided that 75% of the funds were used to maintain payroll and the balance were used for the other categories, the rent, utility, mortgage interest, you can apply for loan forgiveness. So the caveat to that is that there's going to be the amount of loan forgiveness will be reduced to the extent that the average number of full-time employees compared to the prior year is reduced, or to the extent that the pay for any employee earning $100,000 or less in 2019 is reduced by greater than 25%. So you're entitled to the forgiveness, but to the extent that you reduce employee count, or to the extent that you reduce wages beyond 25% specific per employee, they're going to do a pro rata reduction on the amount of forgiveness.
Thanks, Anthony. Maybe you can drill down on that a little bit. I know the rule with respect to employee headcount is a little bit different than the rule with respect to wage reductions. Can you explain those two rules and how they relate to loan forgiveness?
Yeah, sure. Sorry.
No, go ahead.
Essentially, okay. The rule for the headcount reduction is essentially based on full-time equivalent approach, which the term full-time equivalent is not defined under this act, but we're kind of leaning towards the same definition that's in the IRS or that came with the Healthcare Reform Act, which is pretty much where you're aggregating people who work less than 30 hours a week all together to try to get to what a full-time person would equate to. And essentially, the headcount reductions work in a way where, as Anthony mentioned, you're taking your average number of full-time equivalents during the 8-week period that you're paying the payroll cost, and you're comparing that, if you're not a seasonal business, to one of two periods at the election of the borrower. So the borrower can use the lesser of the two, and the periods are from February 15 through June 30th of 2019, or January through February of 2020. So that way, if you had already made maybe some reductions compared to last year early on in the year, maybe you can use the January through February, and that gives you a lower denominator. And that gives you a ratio, and that ratio now is what you're applying to the sum of the forgiveness amount in order to reduce it. So, for example, if somebody had 90 employees during the 8-week period compared to 100 in other periods, they're going to get a 10% haircut on an otherwise eligible forgiveness amount. So that's the headcount reduction approach that's out there. As far as the salaries and wages reduction, that one, it's written very difficult to kind of really interpret how they're going to make the calculation exactly. But the spirit of it is, as long as you did not reduce the wages of your employee in those 8-week periods more than 25%, you should be fine. Any reduction in excess of 25% is going to be a dollar for dollar reduction, and also the amount of wages that, of the forgiveness that you're going to get. And so essentially what they're trying to do is they're trying to make sure that you get back to the employment counts by head count, but also they don't want you to just maintain the same level of head count and just reduce people's salary and bypass that. So they're trying to tackle it from both angles.
Anthony, I understand that there's kind of a rehire grace period that's included in the PPP program. Can you explain what that is and how that works?
Yeah, sure. So if the reduction in employment or wages, if they occur during the period beginning on February 15th, 2020, and ending 30 days after the enactment of the act, so 30 days from March 27th, 2020, there will not be a reduction to the extent that if by June 30th of 2020, the borrower eliminates the reduction in employees of the reduction in wages. So to the extent that by June 30th, you recapture employees that you may have let go or increase their wages back to where they were in the prior period, then that will not be a count in reduction. So a lot of questions that have been asked of me is, well, what happens if for the last week in June, I bring these people on, I keep them for a week, and then we have to let them go again? Do I not get penalized for that because I had them on payroll as of June 30th? And really, it's not clearly defined in the regs or the FAQs, but keep in mind that you have to use 75% of that payroll portion towards, 75% of the loan amount towards payroll costs. So to the extent that you're not meeting that 75% requirement, you're not going to get reductions or forgiveness. So.
And it seems, Anthony, from your perspective, it seems to be an all or nothing type of approach, right? So they want you to pretty much take a look at what February 15th headcount was and then have that same number on June 30th, and not more like, hey, I hired 5 of the 10 that I let go. Do I get partially applications toward my reduction? It seems to be like you have to hire back up to a certain level on an all or nothing. Is that how you're seeing it as well?
Yeah, all or nothing for a pro rata reduction, right? So that's correct. Yep. Now keep in mind that the SBA they haven't issued guidelines on loan forgiveness yet. I'm told that they'll be coming out any day now. So I'm sure they're going to have some tweaks or adjustments in terms of what they issue, or at least some clarifications to make these points more clear as to how the forgiveness is exactly going to work.
I think there's an interesting point here, and Jerry, maybe I bring you and Ollie in on this. This PPP program, the idea was to make sure employers, try and retain their employees, right? And I think what it doesn't anticipate or doesn't consider is that, yes, with many industries, you're in your own control of whether you keep your employees or not. In the staffing industry, you're not in that control, right? When your workforce is largely a contingent workforce and your clients start canceling orders, right? You've lost the ability to control who you can maintain or not. And that could cause a problem. What have you been telling your clients who anticipate that they're going to be losing orders during this time period, and therefore it's going to be very difficult for them to maintain their headcount at the end of the period?
Yeah, that's a very interesting question, and that's one that I think everybody from every industry that's affected by a shutdown is really impacted by, because a lot of people are saying, well, I really can't rehire my employees. But the Marty, the premise behind the law is that the government doesn't care if the employee can actually work or not. All they care about is the fact that you can pay their paycheck, even if they're sitting at home and they're not working. So this is not meant to kind of subsidize payroll as much as it's meant to simply make sure that everybody's still getting a paycheck for that 8-week period. And so even if orders are canceled or folks can't open their doors and they can't really bring their employees back to work, so long as that employee is not obviously working elsewhere, and they are expecting you to still pay them and to bring them back on payroll.
Yeah, and I concur with what Ali's saying, Marty. And one of the things that I've been instructing the staffing firms is look, the money's out there. We should be applying for, because let's say it does take 3 weeks to get funded. And if in that 3 weeks, the world does start to open up and all of a sudden you have new orders that you need to get people out into the street and start working, that's where this PPP is going to really help you. And I've also, agree with Ali is that unfortunately, there could be a 3 to 4 week period that we may be paying people to sit out there, for that loan. And then the next question that we get asked is, well, why wouldn't I just let them be on unemployment? And that's the question that we're all struggling with. And again, this is not the comment I'm going to make right now is really a comment for an attorney down the road. But if I have an employee that I now say, look, I am now going to start paying you your wage, and they come back to me and they say, well, I'm making more money on unemployment, I would prefer you not to do that. At that point is where I believe the big issue is going to come, is because did that employee just terminate themselves legally by saying I'm not coming back to work because I had more unemployment? So our recommendation as of right now has been, let's get out there, let's get the lending dollars in place, let's get everything that we need to do. And then as we get funded, we got to start making some real strong decisions, because then at that point too, Marty, we'll have more guidance on how this whole loan forgiveness is going to work as well.
Yes, I think that's the key, is that all the guidance isn't out on the loan forgiveness. Hopefully, as they've been able to think about it, they'll understand and contemplate some industries that, like the staffing industries, that are maybe unique in their control over their headcount. I want to bring Loni in because this is going to be our last topic of the day, but it's quite important because there's a lot of new tax programs that are out involving tax deferral, tax law changes, and some tax strategies that staffing firms should be thinking about during this time period. Loni, thanks for being patient. So why don't we start with the worker retention credit? Maybe you can tell the audience who is eligible for that credit.
Yep. So as we've alluded to throughout the presentation, the goal behind these are to keep people working. And so one of the credits available is the worker retention credit. I want to point out first that if you do receive one of the Paycheck Protection Program loans, you're not eligible for the worker retention credit. But otherwise, those who don't, it's available to all employers regardless of size, and the credit is 50% of the wages paid to an employee capped at $10,000. So it would be a $5,000 credit essentially per employee. And so to be eligible, your business has to be fully or partially suspended because of the COVID-19, or whose gross receipts who have declined by more than 50% over the last calendar quarter. So it's an OR test there.
Okay, great. And then also there is a deferral, I believe, on your FICA taxes. Can you explain, actually, first maybe confirm that that's true, and second, maybe explain how that works for our audience?
Yep, that is absolutely true, that there's a credit for the employer share of the Social Security portion of taxes, the 6.2%. The 1.45% share of the FICA taxes still has to be paid. Again, like the employer retention credit, this the deferral does not apply to those that have received one of the PPP loans from the SBA. But what it allows you to do is it's for taxes incurred from March 27th through the end of the year that you get to defer paying your share of the 6.2%, and you get to pay it in 2 tranches. 50% will be due by December 31st, 2021, and the other 50% will be due by December 31st of 2022. One thing that I do want to point out that it's specifically in the rules state that if you use an agent to facilitate your payroll, it's the employer's responsibility to ensure that the deferred taxes are paid in, not the agent's. Just anybody that's using payroll processors to be aware that you've got to make sure that there's some form of communication so that if you do the deferral that the taxes are paid in at the later dates.
So Loni, it seems like a no-brainer. If you're not eligible for the PPP program, you should be taking advantage of these 2 opportunities. What are you telling, since there's an exclusion, what are you telling your clients who are eligible, who are in the process and don't know if they're going to receive money from the PPP program? What are you telling them to do with respect to the worker retention credit and the deferral of the Social Security portion of the payroll taxes at this point? Are they holding off on that, or are they taking advantage of that and then going to stop taking advantage of it? What's the advice you're giving now?
No, the advice is to take advantage of it. Specifically, though, with the employer retention tax credits, they do a carve out or a true up in a sense where you have to pay it back and make it whole so that you're not getting the best of both worlds. But absolutely, while you're waiting for it, take advantage of the credits that's there.
Great. Okay, here's a subject that confused me in my law school tax class, and that is net operating losses and their carryover and carry back. I know a number of industry businesses and staffing firms will probably have down 2020s. They'll probably have net operating losses. This can be an opportunity in the future. Maybe you can explain this complicated concept to our audience.
Yeah, absolutely. So under the tax reform that passed in late 2017, the government did away with net operating losses being able to be carried back. You could carry them forward and only offset 80% of the taxable income. So this was one of the revenue raisers under tax reform, in that you couldn't ever fully do away with tax liability. Well, this part of the CARES Act undoes that. And it says that any net operating loss from not only 2020, but 2019 and 2018 can be carried back 5 years. And then anything can also carried forward can offset 100% of taxable income. So we're waiting on, let's say, official guidance, if you will, in the process on how to do that. But there's planning opportunities there for not only 2020, but if for some reason you had a 2019 loss, 2018 loss that you couldn't carry back, you now have the ability to go back and request a refund for any of those losses.
Loni, can I just ask one question while we're, and Marty, not to cut you off. What if I had a 2018 operating loss? Since so many staffing firms are cash basis, it's possible that happened. Would they be able to carry that back to 2017 if they have not yet filed their 2019 and carried it forward?
I believe so. I also expect the net operating loss rules to work like it did in the past, and that you'd have to go back to the latest year first, right? So you'd have to go back to 2013 if I'm doing my math right. But yeah, I would assume so. I guess I should put the caveat out there that I haven't heard otherwise, but I would assume you can.
Thanks, Loni.
There was also a change to the depreciation rules in the Act. Could you explain the history on that, what the change is and how it works?
Yep, absolutely. With the same tax reform from 2017, there was this, it's commonly referred to as the retail glitch, in that the wording wasn't written properly in that while the government intended for leasehold improvements to non-residential property to be eligible for accelerated first year 100% bonus depreciation, the way it was left is that it wasn't available to that, and it had to be depreciated over 39 years. So you were slowly eating away at depreciating these improvements. The CARES Act has undone this as well, or I guess fixed the language as it should have been, and that it now is eligible for the 100% bonus depreciation and has a class life, if you will, of 15 years. One thing that I will point out is that we're waiting on the guidance, though, if you'll be amending prior year tax returns for, let's say, 2018 to take advantage of this depreciation, or if it can be a method change in a current year tax return. So that we're still waiting on. But if anybody's done a build out to an office or things like that, this may be a planning opportunity where they may be able to take some additional depreciation deductions.
Thanks, Loni. And what about the cap on interest payment deduction? Has that changed?
Yep, really this CARES Act did a whole lot of undoing of the tax reform from a couple of years ago. But with the tax reform, the IRS and the government instituted a cap on how much interest could be deducted, and it could only be 30% of what they defined as adjusted taxable income. For simplicity, it's along the same lines as of EBITDA. So if your interest expense exceeded 30% of your EBITDA, it had to carry forward. You didn't get to deduct it. For 2019, and 2020, they've adjusted that to a 50% marker. And then they've also stated that in doing your 2020 tax returns, you have the ability to elect to use your 2019 EBITDA, with the theory being that your EBITDA from 19 should be better than 20, so it'll give you that higher limit to be able to deduct that interest expense. One item to note is there's a couple nuances for those that have partnerships with limitations, but without a slide and a diagram, I don't know that it's necessary to ramble about it right now.
And then one last thing, because that I think is interesting for folks to know, because it's another source of capital or relief in this, and that is the relaxation of kind of the rules regarding use of retirement funds. Can you walk through that a little bit as well?
Yep, absolutely. So there's they've made several changes, let's say, to retirement funds, and the first one being for those that are eligible or required to take required minimum distributions. They've done away with that. But I think that doesn't necessarily help people that need funds, but those that help people that need funds is that you can make a premature distribution from a qualified retirement plan. And so what it says is that and normally it's subject to a 10% penalty if you take that premature distribution. And so if you take a coronavirus related distribution up to $100,000 in 2020, the 10% penalty won't apply. The distribution, however, will still be subject to income tax, but that income is going to be spread over a 3-year period unless you elect otherwise. And then there's also an extension of those who maybe have taken a distribution from a plan or an IRA that have to roll it over. Usually the rollover period must be done within 60 days. They've extended that you can repay that distribution within 3 years. And then one of the old rules, Marty, was that you used to be able to borrow up to $50,000 from a qualified plan. And what they've done is they've temporarily increased that to $100,000, starting on the CARES date enactment, which is almost 2 Fridays ago, I think the 26th. And so you can borrow up to $100,000 from your qualified retirement plan.
Thank you. Okay, Ali, I hate to do this to you because we've run out of time, so I'm going to give you kind of a lightning round question, and because we haven't really covered the economic injury disaster loan program, could you give maybe a 2-minute overview of what's important about that program for our audience?
Sure. Essentially what's referred to as the EIDL program, it's the Economic Injury Disaster Loan, is out there through the SBA. That one, you apply directly through the SBA and not through your bank. And that's a straight loan program. They did introduce a $10,000 grant attached to the program as part of the CARES Act, which a customer could essentially apply for. And essentially, right now, there's still no guidelines on when that money is going to be released. It was supposed to be 3 days, but that hasn't happened yet. The terms of those loans are a little different than the PPP loans, and the interest rate is 3.75%, and it's up to a 30-year of amortization. So they determine how much to really give you and how much terms they're going to give you, because it's a credit-based decision. So unlike the PPP, where you're just going in with your payroll cost number and there's a forgiveness amount and it's 100% guaranteed by the SBA, this is actually just a pure loan mechanism. So they're going to look at the financial statements and they're going to determine whether the applicant has the ability to pay back that loan. Now, the CARES Act did also loosen up things a little bit, where loans under $200,000 don't have to be guaranteed, but stuff over $200,000 does have to be guaranteed. Items or loans over $25,000 require collateral for this particular program. However, where this program can come in handy is there's not a whole lot of limitation on its use. So the uses of funds can be used for payroll-related items, to pay regular debt payments, as well as to pay accounts payable and other stuff. You can't use them really to like pay down substantial principal amounts, but everything that would be normally scheduled, you can use to pay it. So for folks that might not be heavy in payroll, that could be a program where they can get a lot more money than what the PPP would offer. But from a staffing perspective, given that payroll is a big driver, the PPP seems to be a much better fit than this EIDL loan.
Well, I want to thank Jerry and Ali and Loni and Anthony for joining. You really shared a lot of tremendous information for the audience. Audience members, as I indicated at the beginning, we will be sending you a link to the recording of this webinar later this week. We weren't able to answer all of the questions, but as I promised, we will be directing those questions to the panelists, and the panelists will be reaching out individually to answer the questions that we weren't able to answer today. Everyone enjoy their day, and thank you for tuning in. Take care.
Thanks, Marty.
Thank you.
Thank you.